News Talk 94.5 WPTI, 96.7 FM WTOB. And you're listening to The Wealth Guardians with Doug Ray, helping you to retire the job, keep the paycheck. I'm your host, Doug Ray, and with me is Brice Payne. Today, we're talking about what football teaches us about retirement planning. Brice, that is very, very appropriate for the season.
It is indeed, Doug. And you know what? I am elated because last week, my alma mater, the CU Buffaloes, were down at the very number one spot of the bottom 25 in the AP poll. They have now, with a victory after firing their coach, their first victory of the year, have climbed all the way up to spot number 4. So I am having a great week. I got to watch a great football game last week. I didn't have a dog in the race, but you saw the Alabama-Tennessee game.
I'll tell you what.
That's as good as football gets right there.
That was something. And then my alma mater came back and won in 4 overtimes.
4 overtimes.
I think the first time we've ever gone to 4 overtimes in school history.
Outstanding, outstanding. You know, sometimes it feels like if the Wealth Guardians, somebody at the Wealth Guardians is a fan of a football team, it feels like a curse.
Yeah, right.
Sometimes. So at least we had a couple of wins out of all of our Broncos. Just looked absolutely abysmal again.
Panthers were awful.
Whatever. But we're wearing our new Wealth Guardians football jerseys
we are.
here.
Yeah,
we got these. Folks, you got to tune into the website. There'll be pictures of us on here. We've got these new great Wealth Guardians football jerseys. Go to our website, thewealthguardians.com, and take a look at them. If you ever see Doug or myself or Garrett out wearing these, feel free to say hi to us. Love these things.
Retire the job and keep the paycheck on the jersey.
And number 59.5 for the in-service rollover age. You need to be aware of that. If you're not aware of that, you need to ask a financial professional. Doug, before we get started on these, what football teaches us about retirement planning, let's do our Wealth Guardian service salute to all of our men and women who put on the uniform out there and your families. Thank you for what you do. You are in our thoughts and our prayers every week, as always, here at the Wealth Guardian. So, Wealth Guardian service salute to you out there. Doug, Garrett, thank you guys for your service as well. Doug, let's talk about football here. You know I'm a big fan of analogies.
Yeah, you are.
At this time of the year, you can find football on TV. The only 2 days that I'm aware of that you can't find football on TV is Tuesday and Wednesday. You got football on Thursday, you got football on Friday, Saturday, Sunday, and Monday. So aside from those 2 days, I'm watching football. But we want to take a few minutes here and go over the concepts of the game of football and how they apply to actual retirement planning. So we're going to be using some analogies for you here. And the first one we want to talk about, Doug, is the red zone. Mm-hmm. So in football, the red zone is that last 20 yards before you get to the end zone, and mistakes are incredibly costly. And it's more important that you make the right decisions at that particular point in the game. And how would you say that applies to retirement planning? Well,
in retirement planning, it's very appropriate. The last 5 to 10 years prior to retirement, we could call that the red zone of retirement planning. And mistakes are very costly in that period, too, especially that last 5 years. You can screw up an entire retirement if you don't do things properly in that 5-year period.
That's exactly right. The red zone of retirement is those last 5 or 10 years. As we are apt to say, Doug, losses mean more than gains in retirement. So in retirement, as you're saving for retirement, that 30, 40-year period, that's the main part of the field there. Mm-hmm. And, you put the ball up there, you're taking some big chances. But when you are down to the red zone, the last couple of years before retirement, you do not want to turn that ball over. And the field is more congested. It's harder to get those last couple of yards because all those defenders are within a tighter space. So it's harder for your wide receivers and your backs to try to find that open part of the field. It's the same thing. You can make a mistake in the last couple. Let's put it this way. If you make a mistake in retirement 20 years before you retire, you've got plenty of time to overcome that mistake. You make a mistake a couple of years before you want to retire.
And Brice, this has been a brutal year for the markets. And if you're in that 5-year red zone for retirement, this has been tough on you. I read a statistic the other day that the average 401k plan in America is down over $30,000. And if you're older, if you're in that 5-year window, it's probably down $100,000. That's a lot to try to make up.
It is. Percentage-wise is usually what we go by.
Right.
It's down about 30% right now if you were just in a stock-oriented mutual fund. Yeah, that's when your portfolio is down 30%, you've got to come back up about what, 58%, something like that?
Something like that, yeah.
That's tough. That's tough to come back up that much, particularly when you're taking distributions from your 401k. All right, the next one that we want to talk about is a hurry-up offense, Doug. I love this one. In football, you're behind in the fourth quarter. You normally run a hurry-up offense to try and create as many chances as you can to catch up in the points there. In retirement planning, how does that hurry-up offense?
You know, I love to watch a really good football team play the hurry-up offense. Mm-hmm. It can be like magic, but not in retirement. In retirement, the hurry-up would be you're trying to take too much risk to try to catch up for what you left behind. That can be absolutely damaging to your whole retirement plan. Too much risk. In a market like we're in now, well, you've really hurt yourself. That's one of the things we do in our planning is we try to de-risk the portfolio when it comes in here. And one way to do that is to cut the fees, because if you can cut the fees on the portfolio, then you can de-risk it to get the same amount of return over time.
That's exactly right.
No hurry-up offense here.
Well, there's a reason that a team doesn't run the hurry-up offense all the time is because it's easy to make mistakes. You've got to take your time and analyze what the defense is doing on the field and making adjustments at the line of scrimmage. You don't want somebody jumping off sides too early. There's a lot of mistakes that can be made. That's why a team doesn't like to run the hurry-up offense. So if you are running it, it means generally that you made some bad calls earlier on in the game, and you're trying to recover for that. All right, very good. Speaking of hurrying up and whatnot, Doug, I would encourage everyone to hurry up and either call us or go to our website because we've got a seminar coming up here.
Yeah, we sure do. It's the last educational event of the season. And as always, we've done this the last 4 years. We're bringing in our Social Security expert, Hamilton Morales. Last year, he was a huge hit for our folks that came in. Hamilton taught Brice and I everything about Social Security, got us certifications in it. He is our go-to guy. He is literally the walking, talking encyclopedia of Social Security. Listen up, folks. Here it is. November the 10th. That's a Thursday evening at 6:30. Then again on November the 15th. That's a Tuesday evening. Call to register at 336-391-3409 or go on our website, thewealthguardians.com. The event tab is right there in front of your eyeballs. Hit it and register right there. Hamilton Morales in the house, November 10th and November 15th.
And Social Security is one of the main legs of your income source in retirement. There's lots of ways to file for Social Security. You do not want to get that wrong. Hamilton Morales knows more about Social Security than 95% of the people working at the Social Security office, I would say.
Amen to that.
He knows his stuff inside and out. And again, you don't want to get your filing wrong because there's only a limited amount of time that you can undo that filing mistake. We will help you figure out, or a good financial planner in general will help you figure out which ways to file for Social Security make the most sense for you. There's a lot of different ways to file. You don't want to make that mistake. All right, if you're just tuning in, you're listening to the Wealth Guardians, and we're talking about the money gridiron, what football teaches us about retirement planning. So getting back to that topic here before we go into our break, the victory formation, Doug, I like this one. So in football, when you have a win within your grasp, sometimes the only thing you need to do is avoid fumbling the ball. So you line up in a victory formation, you take a knee and you run out the clock. You don't care about gaining more yards or putting more points on the board. Doug, how would that relate to retirement planning?
Well, in retirement planning, basically, it's akin to stop worrying about getting more money, making more money. You know, that was the hurry-up offense. Now that you're in retirement, it's more about defending your portfolio, especially in a time like we're in now. You know, make sure you don't lose anything. Don't go backwards. You know, let's take little baby steps forward, but no steps backwards.
The most important thing is not fumbling the ball at that point in the game. Doug, you know, I often use a question for our clients who are taking on more risk or feel comfortable taking on more risk than they should. A lot of people will ask themselves, how much risk can I afford to take? And really, I would encourage somebody to ask themselves the questions, how much risk do I have to take? And I like the way this victory formation kind of phrases that question. That I'm going to start using this from now on. Well, Doug, I love this topic. I wish we could do this more often, but we should come back and tackle this next football season as well. In our second segment, we're going to be talking about taxes and the new tax laws that just came out for the new tax brackets and whatnot that came out for 2023. So we're going to talk about that in the second segment. But before that, as always, we've got the trivia question.
Here we go.
Doug, you ready?
I guess.
All right, here we go. Garrett, you're back there. You listen up as well. No cheating, no pulling out your phone. Doug, on October 18th, 1867,
Oh, boy.
Alaska became part of the United States. Now, it didn't become an actual state until January of 1959. Actually, Alaska still celebrates October 18th as Alaska Day. It was bought from Russia for $7.2 million. What a deal that was. All right. How long, that was the 49th state, how long did the 49-star version of Old Glory fly?
Ooh.
You've got to do a little bit of math and thinking here.
Wow.
We're going to let you do the math and thinking. We're going to be back on the other side of the break. Let's see if we stumped Doug, and more importantly, I want to see if I stumped you out there. This is Brice Payne. With me is Doug Ray. The show is The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB. News Talk 94.5 WPTI. 96.7 FM WTOB. You're listening to The Wealth Guardians with Doug Ray, helping you retire the job and keep the paycheck. I'm Brice Payne along with Doug Ray, and on this segment we're talking about the highlights of the changes in the new revenue procedure for taxes for 2023. An exhilarating topic, but a lot of changes are out there that I'm sure are important to you. What else is important to you is to see whether or not you got our trivia question right this week, and to see if Doug got it right again this week. He's been getting them right recently here. But what we want to ask you before we get to the trivia question is we want to ask you, are you looking forward to retirement? What's your answer to that trivia question? The correct answer is yes, I am looking forward to retirement. The second trivia question is, do you want to confirm that you're making the best decisions for your retirement? The proper answer to that is yes, absolutely. I want to make sure I'm making the best decisions for my retirement. Well, then Doug and Garrett and I have great news for you here at the Wealth Guardians. We offer a no cost, no obligation, I'm going to repeat that, no cost, no obligation opportunity to sit down with financial planners who are retirement income certified professionals and who are fiduciaries, and see if you are on track for your retirement plans and your goals and your dreams and your objectives. We want to help you retire the job and keep the paycheck. The only caveat to that is that you've got to call us. Doug and I have tried repeatedly to call you, and we can't get through to you, so please pick up the phone and call us. If you're anywhere close to retirement, again, don't be in that football red zone and not be in a proper lineup. 336-391-3409 is our phone number. That's 336-391-3409. You can also reach out to us at our website, thewealthguardians.com. Having said all that, now it's time for the trivia question.
Here we go.
Let's repeat this. Doug, on October 18th, 1867, Alaska became a part of the United States, and they recognize that date to this day as their Alaska Day. But it didn't become an actual state until January of 1959 as the 49th state, thus initiating the 49-star flag. My question to you is, how long did the 49-star version of Old Glory fly?
Not long, because Hawaii came into the picture, so I'm going to say less than a year.
All right. That was a pretty broad answer, less than a year, but you are technically correct. So we'll give you the give you the buzzer on that.
By the way, another
dinger.
trivia. Sarah Palin told me that Putin wants Alaska back. No, I'm just kidding.
I'm sure he does. There's a lot of good energy there. That's probably a huge tactical mistake. Of course, when we got that from him in the 1800s, we weren't particularly the adversaries that I think on the global stage that we are now. But here's a few more facts about this. So Alaska became a state on January 3rd, 1959. Hawaii became a state on August 21st, 1959. So 7 months and 2.5 weeks later. So that is the amount of time that over the White House and the Capitol building that we flew a 49-star flag. And I looked it up. You can actually buy an authentic 49-star flag on Etsy right now for just under $2,000.
Wow.
So
original?
An original one, right.
Wow.
Yeah. So if you're inclined not to fly the 50-star version of the Stars and Stripes for some reason, you can go out there to Etsy. Now, here's a follow-up question for you. Let's see if you can get this one. What was our 48th state? What was the last state to be a state before we got Alaska and Hawaii?
No idea.
Garrett, you have any idea over there?
Well, he's quiet.
No, he's quiet. That means no, he doesn't. It was Arizona. Arizona was our 48th state. So, all right, very good. So everyone out there in Hawaii who's listening, congratulations on Alaska Day this week. All right, Doug, let's get to our main topic here. Most common retirement planning questions about taxes. So as we approach the end of the year, saving money on taxes becomes a obviously bigger focus for many people out there. But let's broaden the scope out, Doug, for this particular episode and focus on some of the most common retirement planning questions about taxes. We're going to talk about mistakes to avoid and how a proper plan can make a significant difference in someone's tax savings. So a lot of people wonder if there are strategies that they can use, Doug, while they're still working to improve their tax situation down the road. How do you usually respond to these kind of questions? So I'm going to pose these questions to you. We see these questions, and you share with us what our typical response is. So here's common question number one. Am I going to have as many deductions in retirement as I did while working?
You know, Brice, it's our experience that most people don't. Let's look at it this way. By the time you're ready for retirement, about the only write-off you may have is your mortgage interest.
Right.
And most people have either paid their mortgage off or they've paid it down so much they have very little interest, not enough to even get to the standard deduction.
Right.
So most people, unless they're a business owner, don't have nearly the amount of deductions. In fact, most people's on their 1040 are just taking that standard deduction.
Well, and true, but the question is, while I'm still working. So if you are a business owner and you've retired, then you don't have those business deductions anymore. So even the business deductions, if you're technically retired, those don't apply either. So
right.
Yeah, there's a lot of deductions that you are used to that once you retire and are not collecting that paycheck, those deductions are often gone. So that's a great answer. Don't count on those deductions once you're retiring. Next common question. Common question number two, Doug. Are all of my retirement accounts taxed the same?
I would say most are. Most of your qualified plans, 401ks, 403bs, SEPs, IRAs, when you withdraw the money out of them, it is basically taxed as ordinary income.
Right.
There's a few exceptions. Roths, they're not taxed at all. If you have cash value life insurance, if it was built the proper way, you take a loan out on the cash value, and that's not taxed at all either.
A LIRP, life insurance retirement plan.
Exactly. So for the standard type of retirement plan, most of that withdrawal is taxed as a normal income tax.
As a normal income tax. Another exception to that would be, even though it's not technically a retirement account, a non-qualified, meaning an individual or joint account,
True.
That's taxed as short-term capital gains or long-term capital gains when you sell the assets. But why were you saving all that money was for retirement. So in your eyes, that might be a retirement account, even though the IRS doesn't view it as a retirement account.
Yeah, and interestingly, take it a step further, if you have a non-qualified annuity, well, that money is going to grow like in an IRA, tax deferred.
Yes.
But then when you start withdrawing it, the IRS says, okay, you're taking out gains first, then that's taxed as ordinary income. Once you've taken out all the gain, then you're taking out principal, so that's not taxed.
No tax on that at all.
Then, to make it even more complicated, if you annuitize it, then you have basically the ability to get the ratio of principal to gain so you can actually lower your tax basis that way.
It's helpful. We're not big fans of the annuities that are annuitized, but if you have that out there and that was your plan with an advisor at some point down the road, that's a key point that Doug makes there. All right. Common question number 3, Doug. Is there a way to get tax-free income in retirement? Now, I know you love this question.
I do. Absolutely. 2 good ways. One is doing Roth conversions, or while you're still working and have earned income, start making contributions to a Roth account if you're not income limited that way. The other way you mentioned a moment ago, Alert. Life insurance retirement plan. I've got one. My wife has one. Many of our clients have them. And basically that is a specially designed life insurance policy that is built to grow cash value very rapidly. You quickly fund it between 5 and 7 years. And the ideal time to start taking money out of it is between 65 and 70. That money basically comes out as a loan against the policy. It's tax-free. You never pay the loan back because the death benefit pays the loan back, and whatever is above and beyond that, a beneficiary gets.
They're very good. All right, excellent. So a lot of good common questions there. What we want to dip into now is, Doug, yesterday the IRS came out and announced the changes in the revenue for the 2023 tax year. So this is moving forward. Once we hit December 31st, moving forward, this is going to be the changes in the tax numbers for the following year. So the standard deduction for married couples filing jointly for tax year 2023 rises to $27,700. That's up $1,800 from the prior year. If you're a single taxpayer, that was for single taxpayers. Married individuals filing separately, the standard deduction rises to $13,850 for 2023. That's up $900. Now let's talk about marginal rates. For tax year 2023, the top tax rate remains at 37%. There's no change there if you're an individual single taxpayer with incomes greater than $578,125. If you're a married couple filing jointly, that number goes up to $693,750. Let's talk about the other rates now. That was the top rate. So 35% tax bracket is for incomes over $231,000 if you're an individual, $231,250. If you're a married couple filing jointly, that 35% tax bracket is at $462,500. That tax bracket goes down to 32% for individuals with incomes over $182,100. And it goes down to 32% if you're a married couple filing jointly under $364,200. That's the top of the bracket there.
Yeah, Brice, the marginal rates pretty much stayed the same, and they're going to until 25 when they're supposed to sunset. What they've done in here is basically expanded the income limits, right, which gives us an opportunity for a couple more years to do some Roth conversion planning.
Conversions, yep,
absolutely.
Exactly. What other highlights do you see on here, Doug?
Yeah, I want to go down to the gift tax because that comes up quite a bit in our planning.
Yes, it does. Okay.
So the gift exclusion is up to $16,000, but here's the thing. You can give anybody up to $16,000 and not have to pay a gift tax. But some of our clients want to give more, especially to help maybe a child or a grandchild fund the down payment on a house.
Right.
Well, you can actually file a form to take that off your estate tax exemption, which is $12,920,000 per person, which means a married couple has about $25 million in their estate that they can exempt.
I'm so glad they raised that number for me because that's really going to help me out quite a bit there, right there. So, yeah, a lot of changes in there. And, the point that we want to drive home is that you want to have a fiduciary financial planner on your side when you're going into retirement who understands these types of changes and understands strategies like Doug was going over, whether it's creating a life insurance retirement plan or doing IRA to Roth conversions. These are key ways Yeah, you got to pay Uncle Sam what you got to pay Uncle Sam, but there are key ways to not pay him more than what you have to. And a financial planner doesn't just do investment advice. They do things like this as well. Please give us a call if you want to sit down and talk with us more. 336-391-3409. 336-391-3409. Doug, I'm sorry, we're out of time. Thank you for joining me here in the studio. This is perhaps our last recording in the old studio here. We are moving to our new studio, and we look forward to sharing that with you here soon. I hope all of your teams win out there and you have a great weekend. Take care.